Welcome everyone to Swissquote's daily market talk. It's Friday, June 12th. Today, SpaceX makes its market debut in what becomes the world's biggest IPO by far. Meanwhile, on Earth, uncertainties regarding the Middle East war don't necessarily improve, but US President Donald Trump remains incredibly efficient in driving the market narrative and giving hope to investors. So we will discuss about that and more, but before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
Happy SpaceX Day, everyone! Today is about to go down in history as the day SpaceX blasted off into the public markets and the day Elon Musk became the world's first trillionaire. Note that the company already made history yesterday by selling 555.6 million shares priced at $135 each, raising the 75 billion US dollars that it was looking for and giving the company nearly that $1.8 trillion valuation that it was aiming for. It equals the combined value of the 29 biggest IPOs in the US history since 2000, adjusted for inflation, including Meta, Google, Hilton, Airbnb, DoorDash, Uber, Snowflake, and GM. So yes, it's a huge IPO. So today, everyone will be obviously watching SpaceX leave the launch pad. I discussed in detail in yesterday's episodes what to expect from this IPO today and in the coming weeks and months for those who are interested in what the future could be for the company and for the rest of the market as well. But back to Earth, well, it was a good old day yesterday where Donald Trump threatened to hit Iran hard. Oil spiked, stocks fell. Then he said that the countries were close to a deal to extend ceasefire and reopen the Strait of Hormuz, following which oil fell and stocks rallied. It was a lunatic day, to be honest with you. What's unbelievable is that after 3 months of this nonsense, the markets still move on words that have no substance. Alas, this morning, US crude is testing $85 per barrel level to the downside. That is the lowest level since the early days of the Iranian conflict. Yet there is no confirmation whatsoever from the Iranian media just yet regarding the ceasefire hopes, and there is nothing telling that this time will be the charm. But US and European futures are in the positive. At the time I'm talking here this morning, we are just before the European Open with European indices leading gains, showing how eagerly and how enthusiastically European investors await the end of this conflict. Because the euro area was hit by the European Central Bank's first rate hike yesterday in almost 3 years to fight inflation that spiked past the 3% mark in the euro area amid the rising energy prices. The ECB President Christine Lagarde said that inflation is spilling over the rest of the economy right now and it's not good news. And note that yesterday the market action that we saw broadly was driven by the falling oil prices and not necessarily by the ECB's decision, as a benchmark for 10-year European yield fell sharply and equity indices gained after the ECB announced the rate hike. But the ECB's rate hike is fundamentally bad news for the European economies for the months to come. A rate hike is obviously never good news. It increases the borrowing costs for companies and households and slows economic growth. And in the particular case of the euro area, growth perspectives are already very meager. I say meager not to say negative, because in the first quarter of this year, the euro area printed a negative growth figure of -0.2% on a quarterly basis, and the situation will probably deteriorate in the second quarter with Iran war-led energy crisis. And while another rate hike in September remains very much in play despite economic weakness, unless energy prices retreat sustainably over the summer. And more worryingly, the ECB rate hike will probably not make any difference when it comes to inflation. A rate hike is very efficient indeed in the context of an economy facing demand-led inflation. In this case, by raising interest rates and slowing the economy and demand, the central banks could tame inflation. inflation. But in today's context, the inflation comes from an external shock, which is the Middle East war and rising energy prices. So we know beforehand that the ECB rate hike or hikes will have a bigger impact on growth than on inflation. So why does the ECB hike rates? Because they just can't sit down and watch inflation rise below their target without doing anything. Remember, in 2022, the ECB was criticized for having been too late to react. But in 2011, 15 years ago, it's made a move actually, hiked the rates 2 times to cool down the rising inflationary pressures at that time, and had to walk back that decision just after a few months and cut the interest rates again after the European economies fell off a cliff. So what I'm trying to say here is monetary policy is not an exact science. There are too many factors out there that are in play and they're interacting with each other, which make same decisions echo completely differently across the economies at time t. And central bankers have very little control on the clear majority of these factors, starting from the geopolitical problems. So today we know that whatever the central banks do, only the end of the Iranian war, the reopening of the Strait of Hormuz, and a sustainable decline in energy prices across the globe could appease global inflationary worries and push the central bank hawks out of the room. Anything less than that will not help. Because like in the US, inflation spiked past the 4% mark. We saw it this week, increasing the chances that the Fed, that was expected to cut the interest rates prior to the Iranian war, will now sit still in its place in the best case scenario, or hike as well to fight inflation in the second half of this year. So in summary, the positive reaction that we saw in European equity markets yesterday may hit a wall if we see oil prices spike again. For US equities, technology and global technology appetite will say the last word. And then this will bring us to next week, which will be crowded in central bank decisions. The Bank of Japan is now expected to hike the interest rates to slow the bleeding in the Japanese yen. The dollar yen fell sharply yesterday below the 160 mark after Donald Trump called off the attacks on Iran, but the pair rebounded back past the 160 mark today and remains in a very uncomfortable zone for the Japanese officials. But intervention or no, the only thing that could stop the yen's bleeding in the medium run is a rate hike from the Bank of Japan, ideally next week. Then the Reserve Bank of Australia is broadly expected to hold fire next week after 3 rate hikes since January, and the Bank of England is expected to sit still too, as softer inflation data that was announced in the UK recently has bought policymakers some breathing room. But that relief may prove temporary, as inflation in the UK will likely readjust to reality when the energy cap there is revised and higher energy costs begin feeding through the household bills. In Switzerland, well, the Swiss National Bank is safe for now. Inflation in Switzerland rose too, obviously, amid the rising energy prices, but it rose to 0.6% only on annual basis as a reaction to rising energy prices, thanks to a strong franc that protected Swiss prices from rising too much. As such, the low inflation gives the Swiss National Bank the luxury to wait that the other central banks, pressured by above target inflation, to raise their interest rates, wait for the global economy to slow down under the heavy weight of the coming interest rates, and wait for the demand for energy to slow down and pull prices lower. And indeed, the World Bank predicts that the global economy will expand only 2.5% in 2026. That's the weakest pace since COVID-19 triggered a recession in 2020. Time is everything in the current context. And in fine, if oil prices come down before Swiss inflation breaches the Swiss National Bank's 2% policy target, Switzerland could emerge largely unscathed without lifting a finger. Holy Switzerland. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week to comment the SpaceX IPO and rest of the market. But until then, good day trading and have a lovely weekend.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.